Hey guys, it's Ken. So I get a lot of questions about Be Infinite, what it means, et cetera, et cetera, et cetera. So I figured I'd do a new, fresh video to talk to you about what I think it means. But first, we're going to start with infinite returns using real estate. I get a ton of questions on this. So who doesn't want to know how to use other people's money, give it back, and not have any investment in a deal, and then have lots of cash flow afterwards? So if you guys want to know more about that, stick with me here. I'm going to show you a real deal, something I'm doing right now, something I still own. And this is basically our model for every single deal moving forward. All right, so first let's talk about what I think are three strategies that a lot of people miss that you definitely need to do if you're going to have what I would consider to be an infinite return. The first one, and we keep talking about this, it's cash flow, cash flow, cash flow, cash flow, cash flow. So a lot of people are flippers or capital gains. This infinite return strategy will not work for that, because the whole point of an infinite return is to own something and then have cash flow come out of it later. So on a capital gain strategy, you buy something low and hopefully you sell it high, you scoop that cash, you pay tax, you pay real estate commissions or whatever, and you go buy again. So that's an investment strategy. It's a capital gain strategy. But an infinite return strategy means you get somebody's money or your money and you invest it in something, and then you keep getting the reoccurring cash flow and benefits from that thing long term after the money's out. And I'm going to show you how to do that. The second thing is you do need a value add strategy. So what that means is you want to find something that, let's say the rents are low, or let's say it's partially vacant or 50% vacant, or maybe you've got some high expenses or whatever in there. So you need to have some way to force equity. And I like to use that word force equity because a lot of people buy stuff and then just hope the market carries them forward. And that's not what we're talking about here. What you want to find are things that maybe have a story to them. And the last one, I think, is the most important thing, is you want to make your investors money. This is a big one. And the reason why is if you can show them that there's a cash flow strategy, that there's an infinite return strategy, and there's a value add component to this, then when you guys go raise money, and at the level that you're heading, hopefully you're going to want to raise other people's money and not want to use your own money. In fact, even Robert Kiyosaki says, if you're using your own money, then you're just lazy. So now I don't necessarily agree with that strategy completely, because I like to invest in my own deals as well, but he does have a point. In other words, as you guys are starting to take a look at some of these big deals, if you're always focused on the cash that you have or the cash you do not have, then that's going to be your roadblock. That's going to be your excuse. And what we're trying to do here is raise capital and show your investors that you have a cash flowing deal, you have a value add deal, and you show them the progression of their equity and when they're going to get it back. So another thing that I really need you to focus on is you need to find something broken. So what happens a lot of times, especially with realtors, that you're going to find that these people are selling you something that's, off the plan, or something that's already cooked up. One of the things I like to say is, the bigger the brochure, the worse the deal. So if something's been packaged up and looked at and shopped and marketed and all that stuff, I'm telling you, it's probably not a very good deal, because most deals are found like on the back of a napkin. Most deals are found by using your mind and by seeing something that other people don't see. So things you might want to look for are things that are like highly vacant. So I bought properties that have been 100% vacant, and you have a strategy to put it together. Obviously, if you find something that's 100% vacant, it's going to be worth less than it is if you have a tenant in it or a bunch of tenants in it. So that's clearly a value add strategy. Another one is bad management. And trust me, there's bad owners and there's bad management. There's bad management companies. In fact, 10 years ago, there was a management company in Texas, and we bought one property from them, and they were managing the property for the owner. And I said, let's just follow that management company around and try to find as many properties that they're managing, because they suck. And so a lot of times you can find that they have bad people, bad policies, bad philosophies, a ton of things. They're just not very good at their job. And so you're going to find that, just like anything, There's really good operators and there's really bad operators. And obviously, if you're in the game and you know the business, you can start to figure that out. One of the best strategies is to find something with low rents and high expenses. And this can happen a lot. Right now, I'm in the middle of a property that we're trying to buy right now in Texas. We're actually buying 2 properties for about 648 units total. So there's 2 different buildings. And what we found is the rents are low all over the place. And actually, it's because of bad management. And so what's happened is some of the units that were like renovated are renting for the same ones that were not renovated. And so you start to see all these inconsistencies, and you can see that when you're buying properties on a bigger scale. And all you got to do is dig into the rent roll, and you can see all these inconsistencies on the rents, and that's massive opportunity. In fact, in this property alone, it's about $150,000 in rent growth just here. On the rent side, as you can find rents that are like, maybe they should be more money because they're a townhome, or maybe they have 9-foot ceilings, or maybe they're bigger, or maybe they have a yard, or maybe the location has a view or doesn't have a view. All those kinds of things are things that you can do to try to grow your rent. So this is a great way to take a look at every single property and push your rents up. And these are find something broken. On the high expenses, so we're seeing this now. We're seeing a very high water and sewer bill as an example at this particular property. So we're putting water conservation. Same thing on the electric. Same thing on the insurance. We're having that bid right now. By the way, we're in escrow. We're in due diligence. We haven't even bought the building yet, but we're setting up these strategies on trying to figure out how do we save on these expenses. We're combining the 2 properties, so we're going to save about $100,000 in payroll. And obviously, we're going to have 1 marketing platform as opposed to 2. So there's all these things that you could do as you're starting to manipulate and drive your NOI higher and create value for your individual owners. So you want to find something broken. You don't want to find something that's perfect, that doesn't have any kind of movement, because that's not fun. It's not exciting. It's not going to create this infinite return that we're trying to get at here in a minute. Okay, so now we're going to go right into a real deal. So I'm going to plow through some of these numbers pretty quick, but this is a real building that I own right now. It's 265 units. I'm going to walk you through kind of a strategy and why I believe that a cash flow model versus a capital gain model is far better. Because if I would have sold this in year 1 or year 2, I still wouldn't own this today. So this is a building that I actually own right now. And I'm going to walk you through an infinite return and how it works and why my investors are so happy on this property and, of course, in all the other ones. So we bought this building. It was $19 million. And we went to the bank and said, what can you give me in a loan? And they said, we'll give you $15 million. Okay, so obviously you have an equity issue. And so I needed, what, $4 million in equity, but there were some capital expenses that was needed. And also, there was a value add play. So there was about $1 million in CapEx. Now, we've talked about a lot about NOI. So the NOI on this property was about $700,000. So NOI is basically income minus expenses. So that's what it was. That's what the seller had when we were trying to buy it. But I saw that there was an opportunity. I'm going to talk about that in a minute. So we went back and we said, okay, the loan's $15 million. What's the payment? And the lender said, well, we got a payment of around $400,000. So what that does is that gives us a cash flow of obviously about $300,000. So we had a cash flow of $300,000. We had an investment of about $5 million. And so that's about a 6% return. Not a bad return on something that we haven't even value added at this point. Now, the cool part is we're not going to really talk a lot about today, is we also had a depreciation expense of $500K. And basically what depreciation expense is it's a non-operating expense, and the government lets you depreciate the property over a period of time. That's not something that we're going to really calculate here for you today. This is something that you need to do through your CPA, but just trust me, this is the actual cash flow. In addition to that, you get a depreciation expense, and then for that, we show a $200,000 negative cash flow. So we get 300 grand a year in cash flow, but we report that we lost 200,000. That's how that works. So that's how a real deal is. But here's the cool part. What we found on this property, and again, as I try to find stuff that's broken, we had 265 units. So we had 265 units, and we saw that there was about $100 a unit value add. Now, some of that was putting washers and dryers in there. So that was about $40 a unit. So now I had to buy those, of course. But the other was like just upgrades. So we found that there was some room in the rents and et cetera, et cetera, et cetera. So that was about another 60 a unit. And that was $100 a unit. 265 times 100 is basically about $318,000 increase. So basically, before we bought the property, we said, this has a washer and dryer play, it has a renovation play, and this 318 is going to go right onto the bottom line. It's basically going to increase my NOI. So I already know before I buy the building that I'm essentially going to increase this property to about $1 million of NOI before I even buy it based on this value add strategy. So when I brought the property to the investors, they're like, this is awesome. You're going to grow. We got 300 grand in cash flow now. We're making 6% on our money on our $5 million, and you're going to grow at another $300,000. And so that's how we raised the money on this deal. So now let's fast forward to year 4, and let's walk through the numbers again. So what I did was I actually grew the NOI to about $1.1 million. So we obviously capitalized on that $318,000 of income. I had a little bit of actual expenses that went up, but I also had some rent growth in that 2 or 3 year period before I got to the end of year 4. So we took the NOI back to the bank and we said, what do you think that you will give us for this property, and what do you think it's worth now that we're at a 1.1 million NOI? And keep in mind, guys, we're also now producing about $500,000 or $600,000 a year in cash flow at this point. So the investors are wildly happy. Their returns have gone up from 6%. And they said, we think the thing's worth about 25 million right now. I said, okay, great. So what kind of a loan will you give me? And they said, we'll give you a $20 million loan. I said, awesome. So I took the $20 million loan and I've paid this loan off. I pay obviously the 15 off because when you get a new loan, you pay off the old loan. In addition to that, I paid off the $5 million that I owed to the investors. Now, guess what? I'm now infinite. I've now given all the investors their money back. I've used it through a cash out refinance, and I've done it through a value add strategy. We still own the property. It's 1.1 million. Now, obviously, I have a $20 million loan. So guess what? My payment goes up. And it went up a lot. And it went up to $700K because rates actually went up during that period of time. So I still have $400,000 in cash flow here, which is awesome. So the investors have gotten their $5 million back, and now they're into the deal for zero. They still have the same ownership, and now they're getting 400 grand back. So they're happy because they got all their original capital back. And guess what they do? They go, do that again, do that again. So they give me the money for another deal. And so obviously I still have the $500,000 depreciation because it's an annual depreciation expense. It doesn't fluctuate all over the place. And we show a $100,000 loss, and the people have gotten all their money back. The best part about this is that there's no tax paid because this is a return of original equity. So basically they got their money back. They're still in the deal. It's still producing about 400 grand a year, and there's no tax because even this 400 grand and that 300 grand was covered by the depreciation expense. So now this is why we like cash flow versus capital gains. I could have sold the building, obviously, for 25 million. I would have scooped quite a bit more money. We would have distributed it. We would have paid tax, all of those kinds of things. And then we would have been scrambling to try to figure out how to reinvest it again. So now let me take you out another 4 years, and the management company has done a great job, and now we've grown this to 1.5 million. So how did we grow in 4 years? Basically, we've covered this over and over and over. This is through normal rent growth and good proper management, you're growing your NOI through, if you just calculate your rents over a period of time, you're going to see that this is not that unreasonable to be able to grow up to another $400,000 in NOI growth. So we go back to the bank, we say, what will you give us again? And they said, well, now we think the property is worth about $35 million. And I said, great. So what kind of a loan would you get? And so my partner and I said, let's don't leverage this too much. Let's actually just get about 25 million. But we probably could have got closer to 27 or 28 million, but we decided to do 25 million because we didn't want our payment to get so high that we were squeezed on the cash flow. So then, of course, the payment went up to 1 million. Our cash flow is 500,000. Our depreciation expense is 500,000. And of course, we're still at zero. So let's sum this up. So I gave the original 5 million bucks back here. I gave these people another 5 million here. We made about 400 grand here, so about 1.5 more million. So we paid them additional $6.5 million, almost all tax-free. And we've been basically infinite in this property since year 4. So that's how you take a property that's broken. That's how you take a property that has problems. That's how you take a property that has opportunities, and you manage it, and you use the bank's money by going back through cash out refinances and growing your net operating income and putting more debt on here and pulling the cash out and harvesting and harvesting and harvesting. I still own this building today. It's obviously kicking out even more cash, way more than 500 grand. We've owned it now for, I think, 10 years. But this is the difference between long-term capital gains and cash flow investing. This is it right here, folks. And obviously our investors are very, very, very happy because we want to be infinite here and here. And obviously in year 4, they have not been invested in the deal any longer, and they just keep getting these checks each and every quarter. So hopefully you enjoyed a lot here. This is how you be infinite. This is how real estate investing is done. You can do this too. If you guys like what you saw, obviously there's a ton of work here. Please hit the like button. Please hit the subscribe button. Please hit the notification bell. All this stuff will be available to you guys on show notes, and you don't have to take any notes at all. And keep sending the really, really good ideas for this kind of video. These videos come from you guys, so thank you very much.